There's a woman named Rachel. She's 38, works in HR at a mid-sized logistics company outside Columbus, Ohio. She drives a Nissan Rogue, shops at Target on weekends, and has about $74,000 sitting in a Fidelity account she hasn't touched in 3 years. To most people looking in from outside, she looks perfectly ordinary. Comfortable maybe, but not wealthy. Then there's Marcus. He's 41, makes $210,000 a year as a senior software engineer at a company you've definitely heard of. He has the Tesla, the nice zip code, the gym membership, and he is, by almost every measurable standard, falling further behind Rachel. He just doesn't know it yet. Both of these people are standing at the edge of what analysts at Cerulli Associates are calling the largest generational transfer of wealth in recorded history. A line most people don't even know exists. And the next 24 months are the window. Not the next decade, not someday, right now. If you are someone who makes decent money but still can't figure out why your net worth isn't moving, subscribe and like this video. It will help more than you think. Here's what most people get wrong. When they hear new class of wealthy people, they picture venture capitalists in San Francisco or tech founders who got lucky with timing. They think wealth creation is something that happens to other people, in other circles, with other starting points. That's the wrong frame entirely. What's coming isn't a story about who gets rich first. It's a story about who recognizes the terrain has shifted and who doesn't. Think of it like a river that's been frozen for years. The water was always there. The current was always moving underneath. But now the ice is cracking. And the people who were quietly watching the river, the Rachels of the world, are ready to move with it. The Marcuses are still admiring their reflection in what they assume is solid ground. The real enemy here isn't income. It's the assumption that how wealth was built in the last 20 years is how it will be built in the next 2. It won't be. Let me give you 3 forces converging right now, simultaneously, in a way that has no real historical precedent. The first is the Great Wealth Transfer. According to Cerulli Associates, approximately $124 trillion in assets is expected to change hands between generations by 2048. That number is so large it barely registers. So let me translate it. Gen X households are expected to inherit nearly $1.4 trillion per year over the next decade alone. That's not a distant event. That's roughly $27 billion per week, moving from one generation's hands to another's, starting now. And the vast majority of it is coming from baby boomers who never had a formal plan for what happens next. Rachel understands this. She's been having conversations with her parents about their property in suburban Nashville. 2 houses. And she's been quietly learning about estate structures and how assets transfer. Marcus hasn't had that conversation. He keeps meaning to. The second force is the reset in private markets. For most of the last decade, the best investment opportunities were locked behind doors marked accredited investors only. You needed a net worth of over $1 million, or an income above $200,000 just to participate. Real estate, private equity, private credit, infrastructure funds, all of it was out of reach for the average household. That's changing. BlackRock's 2026 Private Markets Outlook noted that more wealth and retirement investors are now participating in private markets, enabled by new fund structures and lower minimums. Platforms like Fundrise, with over 2 million investors and a $10 entry point, are giving ordinary people access to the same asset classes that institutions have used to compound wealth quietly for decades. This is not a side detail. Yes, this is a structural change in who gets to play. The third force is AI, not as a product to consume, but as an economic redistribution engine. In the first quarter of 2026 alone, venture capital deployed $267 billion into AI companies. That is the largest single quarter of VC funding in history. San Francisco now has more billionaires than New York. The Bay Area's millionaire population has doubled over the past decade. That wealth doesn't stay contained. It flows into real estate, into adjacent industries, into the people positioned around those systems. And critically, AI is now being used to democratize financial intelligence itself. Tools that used to cost $50,000 a year in advisory fees are becoming available for the price of a subscription. Rachel uses 3 of them. Marcus doesn't see the point. And the convergence of these 3 forces, The largest intergenerational wealth transfer in history, newly democratized access to private markets, and AI-powered financial infrastructure creates a narrow but real window. Not forever, not for everyone who waits. But for people who act within the next 18 to 24 months, while asset prices in private real estate are still resetting, and before most of the inheritance capital has moved into active portfolios. Here's where it gets uncomfortable. The people who will miss this window won't miss it because they were uninformed. They'll miss it because they were busy optimizing their current life, busy perfecting the version of themselves that was built for the last economy. Marcus isn't failing. He's doing everything right for 2018. There's a trap I call the "I'll get to it" syndrome. It's not procrastination exactly. It's the belief that the window is always open, that wealth creation is a problem you solve when you have more clarity, more time, more capital saved up first. But windows like this one, the convergence of intergenerational capital, newly accessible asset classes, and a wholesale restructuring of who has access to information, these don't stay open. Think about people who bought index funds in 2009, right after the financial crisis, when everything felt uncertain and dangerous, or people who bought real estate in 2012, when the market looked like it was still broken, or people who stayed invested in tech in 2020, when a global pandemic seemed like the worst possible time to hold equities. The pattern is always the same. The people who acted when it felt uncertain were the ones who ended up with the outcomes everyone else spent years wishing they'd gotten. Right now, it feels uncertain. That's the point. So, what does this actually look like in practice? 3 things. First, have the inheritance conversation you've been avoiding. If you have parents or older relatives with significant assets, property, retirement accounts, a business, and you haven't asked them directly about their estate plan, you need to do that this year. Not because you're waiting on their money, because without a plan, up to 70% of family wealth is lost by the second generation, according to estate planning research from Williams Group. Rachel knows what her parents own, what's in trust, and what isn't. She's not expecting a windfall. She's making sure a windfall doesn't evaporate. Second, move at least $1 into a private market structure before the end of 2026. I don't mean take all your savings and bet it on private equity. I mean, put a small intentional allocation into an asset class you currently have zero exposure to. Private credit, real estate debt, infrastructure. Get familiar with how these instruments work before you have more capital to deploy. The people who will benefit most from these markets in 2028 and 2030 are the ones who started learning the mechanics in 2026. I've been managing capital across public and private markets for over a decade. The learning curve is real. Start it now. Third, stop treating AI tools as novelties and start treating them as infrastructure. The financial intelligence gap between someone who knows how to use AI effectively and someone who doesn't is widening every quarter. Rachel doesn't have a fancy advisor. She has 3 tools, a disciplined reading habit, and a genuine understanding of the trends shaping capital flows over the next 10 years. That's worth more than Marcus's salary. Rachel and Marcus are still sitting in Columbus and wherever Marcus lives. Neither of them has made a dramatic move. Neither of them has done anything that looks heroic from the outside, but Rachel is watching the river. She's been watching it for a while. And when the ice cracks, when that first transfer of capital happens in her family, when that first private market allocation starts compounding, when that first AI-sourced insight helps her see an opportunity 6 months before most people catch on, it won't feel like a breakthrough. It'll feel like the natural result of paying attention when most people were looking elsewhere. The next 24 months will create a new class of wealthy people. They won't be the ones who got lucky. They'll be the ones who understood that the terrain had shifted, and adjusted before the map was widely redrawn. What's your current move? Drop it in the comments. Whether that's your first index fund, your first private market allocation, or just the conversation you're finally going to have with your parents this year. And if this video gave you a clearer picture of where we are, subscribe. There's more of this kind of thinking coming.